Pakistan's coalition government and the IMF have been at the negotiating table since early February.
Cash-strapped Pakistan is awaiting a bailout package of $1.1 billion from the International Monetary Fund. Short-term inflation for the week ending on the 22nd of March has risen to an all-time high. It has hit nearly 47%. Pakistan, who is celebrating the holy month of Ramadan. Demand for traditional food is up as worshippers break their fasts at sunset.
Desperate for flour, the government announced there would be free distribution of it for those in need, and Pakistan is in the middle of an economic crisis.
The situation is very bad. I curse those that are running the country. From last week, the price of flour has almost doubled. We don't want your free flour, just lower the prices.
Basic food prices have more than doubled, while wages have stayed the same. It's the worst economic crisis since the country's independence.
Even getting one meal a day is very hard. My husband died a month ago. I had to take my 2 children out of school to work. The prices have gone up so much. For the poor, it's unspeakably difficult.
Prices have gone up by 300%. Before, $100 a month used to be enough. But now, even if you get $200, you need to borrow money. We can't buy flour, sugar, so many things.
An estimated 8 million people are unemployed, and Pakistan's foreign currency reserves are only enough for a month of imports.
Those who previously ate 2 meals a day now find it difficult to eat once a day. Families have taken the children out of school, others put off going to the doctors, all to save money to feed their families.
Hi, welcome back to Joe Blogs. This video is an update on the situation in Pakistan. As you saw at the start of the video, the IMF bailout deal, the additional $1 billion that the IMF have been in discussions with the government in Pakistan for the past 6 months or so, has still not been released. So Pakistan is still on the verge of collapse. And to make things worse for the people of Pakistan, prices in the week ending 22nd of March rose by 47%. So we've got year-on-year inflation at its highest level for more than 50 years. And Pakistan is currently celebrating Ramadan, which runs from the 22nd of March to the 20th of April, which means that all observing adults have to fast between dawn and sunset. So in today's video, I'll give you an update on the discussions between the Pakistani authorities and the IMF. The reason that there's a hold-up in the release of the additional funding is that the IMF requires certain reforms to be introduced to make sure that Pakistan is on a stronger footing going forward, that it can get itself out of this situation. And unfortunately, the Pakistani authorities haven't ticked all of the boxes yet. So I'll have a look at the new fuel subsidy system that's been proposed over the next 6 weeks, whereby poorer people will be given fuel at a different rate to the rest of the country. We'll then have a look at what's going on with inflation. We'll have a look at that weekly data and see which prices have been driving up inflation in the country. We'll have a look at what's been happening over the course of the last 12 months. We'll have a look at the current situation for Pakistan's debt, because Pakistan is still sitting on the verge of default for all of its debt obligations. We'll have a look at what the rating agencies have been saying about Pakistan, because they've recently downgraded the credit risk. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in Pakistan over the course of the next 3 months or so, and what the implications of this are for the rest of the world. Now, before we go on any further today, I want to talk to you about today's sponsor, Masterworks. Inflation in Pakistan has now hit 47%, and inflation is a major problem all across the world. And the problem with inflation is that it's now impacting on investment returns. And 2022 saw the worst performance since 2008 for the stock market. And Goldman Sachs have recently stated that the market is heading nowhere in 2023. As a result of this, fund managers are now looking into low correlation assets, because even if markets flatline this year, these assets can continue to climb. And according to a recent report by Citibank, of these assets, the one with the lowest correlation is art. Over the last 26 years, contemporary art pieces have provided a return more than double the S&P 500's return. Now, you may be thinking that art as an investment is only available to billionaires. However, Masterworks has come up with a creative structure that lets you invest in multi-million-dollar paintings without breaking the bank. And since Masterworks started trading, they've built a track record of 11 exits, all of them profitable. So in view of these dynamics, it's no wonder that Masterworks has seen over 650,000 investors trying to gain access. And as a result of that, there is now a wait list. Now, I want to make it very clear that I'm not providing investment advice, and before you make any investment, you need to do your own research. However, if you are interested in investing in Masterworks, then Joe Bloggs viewers have exclusive VIP access to their latest offerings, which you can check out by clicking the link in the description below. As a result of the financial difficulties, Pakistan has been seeking a bailout facility from the IMF, and a $6 billion facility was agreed in 2019, and this was subsequently increased to $7 billion in 2021. However, the problem that Pakistan is facing is that the IMF require a country to change the way it's structured to ensure that it's on a firm footing and that it can move towards being self-funding and self-sufficient.
Pakistan's coalition government and the IMF have been at the negotiating table since early February. This wild cash-strapped country awaits a $1.1 billion aid package as chinks in the deal are ironed out. The PMLN regime is currently dealing with the aftermath of devastating floods from last year and an ongoing political struggle with former PM Imran Khan. Amid all of this, the government has attempted to implement several fiscal measures, including a currency devaluation, lifting of state-backed subsidies, and an increase in energy prices, all in an effort to match the preconditions set by the IMF.
In order to meet the IMF's requirements, Pakistan has introduced a 170 billion rupee finance bill, which is roughly around $643 million, which includes increasing the general sales tax in the country from 17 to 18%, reducing the fuel subsidies that are currently keeping prices at the pumps low, and introducing austerity measures for the government. However, these measures have not been enough to meet the IMF's demands, and the Pakistani authorities have now proposed a new programme whereby fuel will be sold at two different prices. One price for the richer people in Pakistan and another price for the poorer people.
To meet the IMF's aid requirements, Prime Minister Shehbaz Sharif announced a fuel hike for affluent consumers that shall be used to subsidize prices for the poor. A Pakistani resident who owns a motorcycle, a rickshaw, or a car with an engine capacity of 800 cc's or lower shall be eligible to avail the subsidy. The minister has revealed that the plan shall be rolled out in 3 phases. In the first phase, petroleum shall be hiked by 75 Pakistani rupees, reaching a base fuel price of 375 rupees, while the money shall be collected in an escrow account. In the second phase, the government shall use 2 different mechanisms to enroll those availing the benefits. Finally, the discount shall be dispersed to the beneficiary post-registration, and the transaction shall be processed at the fuel station. The Pakistani public, however, remains skeptical with the subsidy program.
If a poor person is availing it, it's good. But do you think a rich man who is smart and well facilitated won't just get a bike to evade their premium?
This proposed 2-tier pricing structure for fuel is extremely unusual. I can't think of any other country in the world that is offering fuel at different prices depending on the wealth of the individual. And of course, this is going to be very difficult to actually control and put into place effectively because people will always come up with ways to get around all of these restrictions. But I think what this new system highlights is that the authorities in Pakistan are absolutely desperate right now to meet all of the IMF's conditions, and they're prepared to do virtually anything to get that $1 billion released to get the economy moving again. Weekly inflation data put together by PK Revenue shows that in the week ending 22nd of March, prices increased by 46.65% year on year. This inflation data is based on a basket of 51 different items, 26 of which increased in price, 13 remained at the same price, and 12 fell. And the biggest year-on-year movements in prices were for onions, which rose by 228%, cigarettes, which are up by more than 165%, flour, which is up by more than 120%, gasoline, which is up by more than 108%, diesel's up by more than 102%, tea is up by more than 94%, bananas are up by almost 90%, rice is up by more than 81%, eggs are up by more than 79%, pulses more than 68%, potatoes more than 57%, and pulse mash by more than 56%. So the first thing to note here is the absolute level of inflation. 47% is extremely high. And once that's declared as the official rate for March, it will rank Pakistan as the country with the 13th highest rate of inflation in the world. So that's obviously a concern in itself. But one of the other worrying factors is the rate of increase. We'll go on to talk about the current official inflation figures in a moment. However, year-on-year inflation at the end of February was recorded at 31.5%. So 47% represents an increase of 50% during the course of March. And of course, the other main issue is that the goods that are increasing the most in price are all of the essential items. The price of onions has gone up by almost 230%, flour is up by 120%, and rice is up by over 80%. And in addition to the food items, the cost of fuel is also up by more than 100%. So these are basic items that everybody in Pakistan needs. And the problem that the poorest members of society have is that they don't have any savings. So when prices are rising by 100%, as you saw at the start of this video, what that means is that people have to eat less. They simply don't have the ability to buy as much food as they did this time last year, and so they're having to put less food on the table and people are going hungry. And as we also saw at the start of the video, children are being taken out of school so they can work and earn some money to try to buy more food. So this is a really serious situation. So in order to get a better understanding as to what's been happening over the last 12 months, let's have a look at the official monthly inflation data. This chart shows the movement in the rate of inflation in Pakistan over the course of the last 12 months. And you can see that in March 22, inflation was running at 12.7%, which is certainly a high rate, but is not at an emergency level. And in April and May, we saw the rate increasing to around 14%. However, in June, there was a big jump to 21%, and that continued in July and August. There was a reduction in the rate of increase in prices over the course of the next 5 months. However, the figure for February 2023 has come in at 31.5%, which is the highest for almost 50 years, since 1974. Now, if you follow the channel, you may be looking at these figures and thinking, well, actually, this rate of inflation isn't quite as bad as it is in countries like Sri Lanka and Turkey, so it doesn't seem too drastic. However, a lot of the pricing in Pakistan is actually subsidised. The government is providing subsidies on things like fuel and food to keep prices down. So the actual rate of inflation would be significantly higher if these subsidies were not in place. And this is actually one of the issues that the IMF has raised, that Pakistan actually can't afford to be subsidising all of these items, and therefore it wants the government to remove these subsidies. But the government of Pakistan is reluctant to do that because of the impact that it's going to have on the citizens of Pakistan. And this chart shows food inflation over the last 12 months. And you can see that there has been a rapid increase over the last 9 months. And the rate of increase of the price of food has come in at above 45% in February 23. And if we expand this chart out to show what's been happening over the last 10 years, you can see that the current rates of increase are significantly higher than any time over that period. And these price increases are a major problem from Pakistan's point of view. Pakistan is one of the poorest countries in the world. There are a lot of people living at or below the breadline. So they're spending the vast majority, if not all of their income on food. So the crisis in Pakistan isn't just a financial crisis. We're not just talking about debt default and the fact that they can't make their interest payments. We're talking about people in Pakistan not being able to buy enough food to feed all of their family. Pakistan has been funding the economy using debt over the last 20 years, and the total amount of debt has now increased to 62.5 trillion rupees, which equates to around $225 billion. In terms of the repayment profile of the debt, it's reported that Pakistan has to pay $22 billion in interest and repayments over the course of the next 12 months. Data from the State Bank of Pakistan suggests that the country has to repay total debt of $21.95 billion over the next 12 months. 19.3 billion of that is principal repayments, so actually repaying the debt, and another 2.6 represents the interest that's due. The breakdown of the data suggests that 3.95 billion is due within the next month, 4.63 billion is due in the following quarter, and just under 13.4 billion in the last 8 months of the period. As a result of the ongoing problems, both Moody's and Fitch, the rating agencies, have recently downgraded Pakistan's debt status, with Moody's slashing the rating by 2 notches to Caa3 and Fitch downgrading to CCC. And Fitch provided detailed feedback as to why this downgrade has been introduced. The first issue highlighted relates to liquidity and policy risks and states that the downgrade reflects further sharp deterioration in external liquidity and funding conditions and the decline of foreign exchange reserves to critically low levels. Fitch have stated that they assume a successful conclusion of the 9th review of Pakistan's IMF programme. However, the downgrade reflects the large risks to the continued programme performance and funding, including the run-up to this year's elections. And they believe that debt default or restructuring is an increased real possibility. The shortage of reserves at $2.9 billion on the 3rd of February has also been highlighted, which is less than 3 weeks of imports, down from a peak of more than $20 billion at the end of August 2021. Fitch have stated that the falling reserves reflect large current account deficits, external debt servicing and currency interventions by the central bank, particularly in the fourth quarter of 2022, when an informal exchange rate cap appeared to have been in place. So this is basically saying that Fitch believed that the Central Bank of Pakistan were using its reserves to increase the price of the Pakistani rupee in the international markets to hold it up. Fitch have also identified the refinancing risk on the existing debt of Pakistan as being a major concern. Fitch's figures show that Pakistan needs to refinance $7 billion of debt before the end of June 2023, and that out of that figure, around $4.7 billion is owed to China. However, they believe that the China loans will be rolled over. Fitch have also raised the current account deficit as being a major concern, and although it has reduced from $9 billion at the end of 21 to around $3.7 billion at the end of 22, Fitch are concerned that it may start to widen again. Fitch have also raised concerns about the IMF loan. Firstly, Pakistan's reluctance to introduce all of the measures that the IMF are looking for before the money will be released. And secondly, the fact that the IMF's conditions are likely to prove socially and politically difficult amid a sharp economic downturn, high inflation, and the devastation brought by widespread floods in 2022. Elections are due in October 23, and former Prime Minister Imran Khan, whose party will challenge the incumbent government in the elections, earlier rejected an invitation by the Prime Minister to hold talks on national issues, including the IMF negotiations. So what's the summary and conclusion today? Well, I wanted to post this video to give you an update as to what's happening in Pakistan. And as you can see, the problem that the Pakistani authorities have is that they still haven't managed to persuade the IMF that they've introduced enough reforms to meet all of their terms and conditions to release the additional $1 billion of debt. And from Pakistan's point of view, this is obviously now getting to an absolutely critical level. We are seeing inflation now taking off. As we saw earlier in the video, year-on-year inflation at the end of February was running at around 31%, which was already at a very high level. But what we're seeing now is week-on-week increases in prices that is making food and other essential items completely unaffordable for the majority of people in Pakistan. Inflation for the week ending 22nd of March came in at 47%. However, prices are literally moving on a daily basis. People really don't know what the price of anything is going to be from one day to the next. And that, of course, is a major problem for a country where we've got a lot of people below the breadline. People are in abject poverty. They don't have any savings. They don't have any ability to be able to pay more for food. Now, the government of Pakistan historically has been subsidizing things like food and fuel in order to make sure that the poorest members of society can actually afford it. However, the IMF is making them stop that. It's making them remove the subsidies on food and fuel. And so in order to try to address this and make fuel affordable for the poorest members of society, they've come up with this new two-tier pricing structure for fuel, which is very complicated and looks like it's going to be very difficult to put effectively into place. And as we mentioned earlier in the video, I'm sure there will be ways around it. People will work out very quickly how they can get that lower price, and we may well find that everybody in Pakistan is eligible to get the lower price. But we'll wait and see as and when it unfolds. But the fact that the Pakistani authorities have come up with such a complicated structure shows how desperate they are to meet all of the IMF conditions and to get that money in the bank. Pakistan is still running on empty. The foreign currency reserves that the country is sitting with right now is only sufficient to pay for around 3 weeks worth of fuel and food. That is a crisis level. Pakistan is genuinely on the verge of running out of money. And in terms of all of its debt obligations, it's got repayments of around $22 billion coming up over the course of the next 12 months. Now, clearly, Pakistan doesn't have anything like $22 billion to be able to make those interest and capital repayments. So it's going to have to restructure all of its debt. And the problem from Pakistan's point of view is that its credit rating has been downgraded, so therefore the risk is now much higher. So any existing bondholders are firstly going to be reluctant to renew. However, they don't really have much choice because the only alternative is to put Pakistan into default and try to take them to court, which will be complete waste of time for everybody involved. So realistically, all of the bondholders will have to renew, but the price of those bonds is likely to increase because the credit risk has gone up. And an increase in the bond coupon will increase the debt burden even further because Pakistan will have to pay even more in interest. So realistically, at some point, it needs to ask some of the bondholders to restructure this debt and to write some of it off to actually reduce the amount that it owes. But at the moment, the Pakistani authorities are focused on trying to get the cash out of the IMF so they can buy more food and fuel. But at some point, the debt facilities that Pakistan currently have in place will need to be completely restructured if the country is going to have any chance of getting back onto its feet and getting into positive territory in terms of its balance of trade. So the outlook for Pakistan over the course of the next 3 months is fairly grim. The country is going to have to focus on all of the requirements that the IMF is demanding are put in place to meet its terms and conditions. That's its primary objective. Those requirements are likely to make life more difficult for the people who live in Pakistan because it's going to remove more subsidies, it's going to increase prices, and it's going to increase taxes. So overall, people will have less money. Pakistan needs to work out a way of helping the poorest members of society. The two-tier fuel price structure is one method that they've come up with so far. However, that does look a little bit too complicated to be able to work. But the authorities will need to come up with other schemes to help those poorest members of society. Now, in terms of its debt obligations, I think it's inevitable that Pakistan will default on its debt because it simply doesn't have enough money. Even if it gets this $1 billion from the IMF, that isn't anywhere near enough to pay its debt obligations. And it will be very interesting to see how proactive Pakistan is over the course of the next 3 to 6 months, whether or not the authorities will simply default and wait for the bondholders to take some action, or whether they'll put a proposal forward themselves. Now, in terms of the impact of what's happening in Pakistan right now on the global economy, well, obviously all of the bondholders, everybody that's holding Pakistani debt, is likely to lose money. It's unlikely that Pakistan will have enough money to be able to make the interest payments, let alone the repayments. So the value of those bonds is falling. That means that anybody that's holding those bonds is likely to lose money over the medium to long term. So that will have an impact on the cash flow and profitability for those financial institutions. That could mean that they then struggle to be able to make some of their repayments. And as with any debt default, it will have a knock-on ripple impact all across the rest of the world. However, the problems in Pakistan have been going on for some time, and it's likely that financial institutions that are holding those bonds will have marked down the value anyway internally. So this won't come as a surprise. It's not a shock to the system. Now, in terms of Pakistan's position in world trade, Pakistan is a net importer, so it is buying lots of fuel and food from other countries, and there is a risk that Pakistan can't afford to pay for that fuel and food going forward, and therefore may need to ask for debt facilities, take all of these items on credit. So that could cause some issues with some of those suppliers because they may not get paid for their supplies. And in terms of Pakistan's exports, its main industry is the production of garments, and there is a risk that if Pakistan's struggling to get enough fuel to be able to keep the lights on, that it may not be able to deliver on all of its contracts. So the overall summary of today's video is that the situation in Pakistan right now is absolutely critical. They desperately need that additional cash from the IMF. They're doing everything that they can to try to meet all of the terms and conditions. That's going to make life harder for all of the people in Pakistan. And over the next 3 to 6 months, it's unlikely that Pakistan will have enough money to meet all of its debt obligations. And it's extremely likely that they will default on that debt. So I'll keep you posted on any further news and developments as and when they happen. If you've liked what I've said today, then please give me a thumbs up. And thank you for watching this video all the way through to the end. And as usual, here's something to put a smile on your face.